Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 5, Deductions 4, and from AGI, from Income Tax Fundamentals 2024. So by the end of this chapter, you should be able to explain how health savings accounts, abbreviated HSAs, can be used for tax-advantaged medical care, describe the self-employed health insurance deduction, explain the treatment of individual retirement accounts, also known as IRAs, including Roth IRAs, explain the general contribution rules for small business and self-employed retirement plans, describe other adjustments for adjusted gross income, calculate the itemized deduction for medical expenses, calculate the itemized deduction for taxes, apply the rules for an individual taxpayer's interest deduction, determine the charitable contributions deduction, and describe other itemized deductions. So with this chapter, keep in mind we are going to be discussing for AGI and from AGI deductions. So we accounted for above the line deductions. So in chapter 3, we discuss deductions related to a business. In chapter 4, we also discussed deductions for the production of income or investment, such as Schedule D and Schedule E, and these are considered above the line deductions. So these business deductions, they're generally reported on separate schedules. However, the tax law also permits additional for AGI deductions, and some of them might be associated with business activity, and in some instances, they're unrelated business activity. And we see one here. So we have what's called a health savings account. So with our health savings account, there's 4 types of tax favored medical spending plans that's available to taxpayers. The first is a health care flexible spending arrangement referred to as an FSA. And this is where employees set aside money to cover medical expenses. We have HRAs, health reimbursements arrangements, and this is where the employer funds an account that can be used by employees for medical expenses. We have MSAs, which are medical savings accounts, and these permit deductions for amounts contributed to an account established for medical expenses. And this is for small businesses and self-employed individuals. And effective as of January 1st, 2008, no new MSA accounts can be established. And then we have what's called HSAs. And these are a type of savings account that's established for paying any unreimbursed medical expenses by taxpayers who carry qualifying high deductible health insurance. So as it relates to deductions, HSAs, contributions to these types of plans are deductions for adjusted gross income. They are limited to certain dollar amounts depending on the age and whether the high deductible insurance covers an individual or a family. Earnings and unused contributions, they accumulate in an HSA and they are not taxed. And distributions to cover medical expenses are not taxed or penalized. So, as mentioned, these contributions, they're a deduction for AGI and there's certain limitations and things of that nature. So, as it relates to 2023 limits, the deductions are as follows. The contribution limit for a family plan is $7,750. If it's just an individual, self only, it's $3,850. Then there's also some additional catch up contribution for a taxpayer if they are 55 years of age or older. Then it will be $1,000 per qualifying spouse. And if you are a single individual, the additional catch up contribution over the age of 55 or older is $1,000 as well. The minimum health insurance deductible is $3,000. For a family, for self only, it is 1/2 of that amount, $1,500. And the maximum health insurance out of pocket for a family is $15,000. And for self only, it is 1/2, $7,500. So the funds, again, contributed to an HSA, they may be used to pay medical expenses not covered by health insurance. So HSA contributions, they must be made by April 15th of the year following the year for which the contribution is made. So there are some nuances regarding the HSAs. So as it relates to the distributions from HSAs, they are tax-free when they are used to pay for qualified medical expenses. In the event that a taxpayer takes a distribution from the HSA and it's not used to pay for qualified medical expenses, it's subjected to income tax because it's treated as income. In addition, there's a 20% penalty. However, once the taxpayer is 65 years old, distributions taken for non-medical expenses, they are subjected to income tax, but not subjected to the 20% penalty. Distributions from the HSAs, they're reported on Form 1099-SA. And in the event that you are dealing with a client and they have an HSA, publication 969 essentially is where you can find guidance on how the HSA needs to be handled. Next, we have what's called self-employed health insurance deduction. So one of the challenges with individuals, wanting to start a business and people who, they decide, what, I don't think I want to start a business. This is one of the biggest reasons why. Generally, most companies, they will offer health insurance, and health insurance, as you know, can be very expensive. As a self-employed individual, that means you would need to pay for health insurance out of pocket. So one of the benefits of being self-employed and getting health insurance is that you are entitled to a deduction. So self-employed taxpayers are allowed an above-the-line deduction for the cost of providing health insurance, not just for themselves, but their families as well. So this deduction is meant to give these self-employed taxpayers the same treatment that's available to employees who are offered health insurance as a tax-free benefit when they are employed. So just keep in mind, the deduction of self-employed healthcare, it's not reported on Schedule C with most other business expenses, but instead it's reported as a 4 AGI deduction on line 17 of Part 2 of Schedule 1 and transferred on the front 1040. So some deductible insurance includes the following: medical and dental insurance paid to cover self-employed taxpayer, spouse, and dependents; medical and dental insurance paid for children under the age of 27 who are not dependents; any Medicare premiums; long-term care insurance paid for the taxpayer and the taxpayer's family within certain dollar limitations. So the self-employed health insurance deduction, it is limited by the following special rules, because there might be instances where an individual is self-employed, however, they still have a W-2 job. So in such case, obviously, Uncle Sam tries to close loopholes as they are there. So in the event that you are also covered by an employer, then you might or might not, depending on the situation, be able to take the deduction. So the deduction is not allowed for any months in which the taxpayer is eligible to participate in an employer-sponsored health care plan. The deduction cannot exceed the taxpayer's net self-employed earned income. So this self-employed health insurance deduction, let's say your net income for the business is $2,000 and you paid $3,000 for health insurance, the individual can only claim $2,000 of self-employed health insurance. Let's say an individual has a loss of $2,000 and they paid $3,000 for health insurance. They will not be able to claim any of the self-employed health insurance. Next, there are individual limitations on the deduction for long-term care premiums. Taxpayers who report income on Schedule C are generally considered self-employed. However, taxpayers with income from certain partnerships, S corporations, limited liability companies, better known as LLCs, and farm businesses may also be considered self-employed and eligible for the self-employed health deduction. Self-employed taxpayers who receive the advanced premium tax credits under the Affordable Care Act, ACA, they may only deduct the portion paid out of pocket, not the portion covered by the premium tax credit. So as we can see, there are some nuance related to the self-employed health insurance deduction. Next, we have individual retirement accounts. So there's two principal types of IRAs in the United States. We have what's called the traditional IRA, and this is where the annual contributions are deductible, retirement distributions are taxable, and earnings are not taxable in the current year. So with the traditional IRA, this is like an example of deferring income, essentially. You defer the income. Some, people, they like to strategize tax plans. So in the event, let's say someone is in a high tax bracket now, it is in their best interest to defer income because they assume when they retire, they would be in a lower tax bracket. So they defer, let's just use, $10,000. They defer $10,000 of income. Let's say they are at the 22% tax bracket. So the $10,000 will actually here. So let's say the $10,000, they put it aside. They're in the 2020 and the 22% tax bracket. So instead of paying $2,200, they defer that $10,000 worth of income. And then let's say when they retire, they assume they'll be in the 10% bracket. So whereby taking out the distribution when they retire, 1,000 versus the 2,200, they would save $1,200 by deferring the amount and putting it into a traditional IRA. Next, we have what's called a Roth IRA. So with Roth IRAs, annual contributions are not deductible, retirement distributions are not taxable, and earnings are not taxable in the current year. So this is a saving strategy in the reverse. So as of right now, let's use the example with the same taxpayer. They have $10,000 and they decide to invest it in a Roth. And right now, in their tax bracket, they are in a 10% tax bracket. So they pay $1,000 in taxes for investing the $10,000. And then now when they withdraw this $10,000, they're in a 22% tax bracket. So that taxpayer saves $1,200, sorry, right? So in such case, IRAs are a great tax planning strategy, but obviously there are some nuances, some limitations, and things that must be considered. So IRA annual contributions and deductions. There are annual contribution limits for both the traditional and Roth IRAs. So the Roth or traditional IRA contribution is limited to either the lesser of 100% of the taxpayer's earned income. So it's very important to understand the term earned income. So generally, the IRS, they break income into three categories. There's what's called active income, portfolio income, and passive income. So with our active income, that's essentially you going to work, you are trading time for money. If you are self-employed, you're working for yourself, things of that nature. So those would be an example of active income. You're actively working to earn the income. Then we have portfolio income. That's essentially income where like the money's, money is making money. So that would be dividends, right? You essentially invest into a corporation, you own stocks, and you receive dividends from that corporation. It can also be interest, right? In the event that, let's say, you have bonds and you're receiving interest payments. So portfolio income at the very, surface level, that includes your dividends and your interest. Then we have what's called passive income. And this is in comparison to the active income. This would be like real estate, right? You have the building in and of itself is the structure. There are some exceptions whereby, an individual is like actively participating, but at the very least, there's not much you need to do. The property in and of itself is the driving force for generating that income. So that is an example of passive income. So in the event that an individual only receives retirement income, that's not considered earned income. So therefore, in such case, if there's a situation whereby a taxpayer only has retirement income or Social Security, unfortunately, they will not be able to contribute to a Roth or traditional IRA. So the first limitation is the lesser of 100% of the taxpayer's earned income, or $6,500, $13,000 if an additional $6,500 is contributed to the IRA of the spouse that has no earned income. So maximum contributions to a spouse's IRA is $6,500. In 2023, taxpayers and spouses age 50 and over can contribute an additional $1,000 annual catch-up contribution, increasing the maximum contribution to $7,500. Annual deduction maximums, they're reduced for traditional IRAs if the taxpayer participates in another qualified retirement plan. So if you are currently an employee, you have a job, and the company offers a 401k and you contribute, your annual deduction is going to be reduced if you wanted to make a traditional IRA. Annual contribution for Roth IRAs is reduced for all taxpayers over certain income levels, but it is not affected by a taxpayer's participation in another qualified retirement plan. So as we can see, there are some key distinctions between a traditional IRA and a Roth IRA. So in each case, the maximum annual contribution is phased out proportionately between certain AGI ranges. If a taxpayer contributes to both traditional and Roth IRAs, the combined contributions cannot exceed $6,500, $7,500 if age 50 or older. Taxpayers with income over the phase-out ranges, they may contribute to what's called non-deductible traditional IRAs. So with our non-deductible traditional IRAs, I mean, it's in the wording in and of itself. This is contribution may be made by taxpayers if their income, again, exceeds the phase-out range. So although the taxpayer can't deduct the contribution, all income earned in the IRA account, it's sheltered from tax until the earnings are withdrawn. So when there's been non-deductible IRA contributions, the taxable portion of the withdrawn IRA money is calculated similar to the treatment of annuity. So a lot of times this is a strategy for high income, high net worth taxpayers. They make these non-deductible traditional IRA contributions each year because of the deferral of the tax on the earnings that's in the IRA. So here we have this Roth IRA contribution example. It says, what amount could he contribute if he was age 62? States Noah, age 42, is single and wants to contribute the maximum to his Roth IRA. His AGI is 141,000, thus his contribution will be limited. Using the 2023 AGI phase-out ranges for Roth IRA contributions table, calculate how much Noah can contribute to his Roth IRA. So the solution is as follows. The maximum amount for a Roth IRA for a single head of household, the range is between $138,000 to $153,000, and for married filing joint, $218,000 to $228,000. So in this case, it lets us know that he's single. So the range is as follows: $153,000 minus his adjusted gross income of $141,000. So that gives us a difference of $12,000 divided by 15,000, and that 15,000 represents the difference between the range of 153,000 minus 138,000. So we determine the allocation and we multiply that amount by the maximum contribution that could be made. So therefore, in such case, the allowed Roth IRA contribution would be $5,200. So that's if Noah was 42. Now, in the event that Noah was 62, it would be as follows: 153,000, which is the max again, minus the AGI, which is 141,000, and we divide it by 15,000 again. The only difference is that because of the increase in age, instead of 6,500, Noah has the maximum contribution of 7,500. So therefore, 6,000 would be allowed. Next, we have a traditional IRA contribution example. It says, how much can each of them contribute to a traditional IRA? Liza and Mikhail are married and are both 41 years old. They file their taxes jointly. Lisa is covered by a 401k plan at work and earns $99,000. Mikhail is not covered by a plan at work and earns $38,000. Using the 2023 AGI phase out ranges for deductible traditional IRA contributions table, how much can each of them contribute to a traditional IRA? So the solution is as follows. When one spouse is an active participant in a retirement plan and the other is not, there's two separate income limitations that apply. So the active participant spouse, they can make a full deductible IRA contribution unless the 116,000 to the 136,000 phase out range applies to the couple's joint income. The spouse who is not an active participant, they may make a full deductible IRA contribution unless the higher 218,000 to 228,000 phase out range applies to the couple's joint income. So Lisa and Mikhail's joint income together, the 99,000 plus the 38,000 is $137,000 in total. So since it exceeds the 116,000 to 136,000 phase out range, Lisa cannot make a deductible contribution to the traditional IRA. However, since their joint income does not exceed that $218,000 to $228,000 range, Mikhail, he can make the full $6,500 traditional IRA contribution. So again, whenever a spouse is an active participant in a retirement plan at their job, there are two limitations that apply. So next, we consider Roth conversions. So as mentioned with the Roth conversion, that's a great tax planning strategy for those that anticipate that their tax bracket is going to be higher as they get older. They're going to make more money, so they're going to be in a higher tax bracket. So it's better for them to pay taxes now versus in the future. So sometimes taxpayers, they want to take advantage of it and they want to convert their traditional IRAs into a Roth IRA. So those who decide to do such, these are those with many years to retire. They have a low current tax bracket. There's a high expected tax bracket in retirement, or they have negative taxable income. So when income is generated by the conversion, it is subjected to the current income tax. So as it relates to our traditional IRA distributions, again, there are distinctions between a traditional IRA and a Roth IRA and how the distributions are treated. So with traditional IRA distributions, money that's taken from a traditional IRA is taxable as ordinary income, and it may be subjected to a 10% early withdrawal penalty if it is taken before age 59 and a half. Roth IRA distributions, these withdrawals are tax-free as long as the Roth IRA was open for 5 years and any of the following requirements are met. The distribution is made on or after the date that the participant turns 59 and a half. The distribution is made to the beneficiary on or after the participant's death. The participant becomes disabled. The distribution is used to pay for qualified first-time home buyers' expense. Distributions may be taxable if any of the requirements are not satisfied. And the part of the distributions that represents a return of capital, that is considered tax-free, but the part that represents a payout of earnings, that is considered taxable. So to make that more understandable, let's say someone contributes $10,000 to a Roth IRA. They meet all of the requirements that are outlined here. And let's say the value of the account increased to $15,000. So once they exceed taking distributions in excess of $10,000, the additional amount in excess of their basis of $10,000, that additional $5,000 is going to be subjected to taxes, the earnings, not the contributions. So these are some exceptions to the 10% tax on early distributions. There's an exception for adoption, age, death, disability. If there's a qualified disaster, domestic relations, education. If there's equal payments, health insurance, home buyers. If there's a levy by the IRS, medical expenses, military, rollovers. If there's a separation from service, or if an individual becomes terminally ill. So there are some provisions in the tax law because sometimes life happens and sometimes you need to access the cash. So these are some exceptions to that 10% tax on early distributions. Next, we have what's called required minimum distributions. So with these required minimum distributions, taxpayers that participate in a qualified retirement plan or own an IRA, they must start taking these RMDs, these required minimum distributions from that plan, starting at an applicable age. So starting in 2023, the applicable age is increased to 73 for individuals that turn 72 after 2022, but before 2033. So the excise tax on failure to take RMDs has been reduced from 50% to 25% effective December 29th, 2022. So again, yes, if you do not take out your money and if an individual they didn't take out their money, there's a tax for not withdrawing the money, right? And as we see here, it was as high as 50%, but it was decreased to 25% as of December 29th, 2022. For a taxpayer that's over the age of 70 and a half, they may also elect to make a charitable contribution directly from their IRA. So if it's made before the RMDs have started, the taxpayer may exclude up to $100,000 from gross income. And if it's made after the RMDs have started, then the amount up to 100,000 is also counted towards any RMDs for the year. And in the event that, let's say, a taxpayer contributes more than the $100,000 or in excess of the annual RMDs, unfortunately, there is no carry forward to a future year. So something to definitely keep in mind. And also, as we see here, there are some prohibited transactions. So the following are likely to be prohibited transactions with an IRA account: borrowing money from the IRA, selling property to the IRA, using funds in the IRA as security for a loan, buying property for personal use with IRA funds. If it engages in prohibited transaction, it ceases to be an IRA and it triggers tax on any amounts in excess of basis, and any investments in collectibles are considered to have been distributed to the owner on the date of the investment. So again, IRA owners and family members or the owner, they are not generally permitted to engage in certain transactions with the IRA account itself. Most IRAs, they're held by large financial institutions and invest overwhelmingly in publicly traded investments, and thus the risk of a prohibited transaction generally extremely low. But when there's self-directed IRAs that are controlled directly by the owner and they invest in non-publicly traded assets, is far more likely for them to be at risk for prohibited transactions. As we see here, borrowing the money, selling, using funds as a security for a loan, and buying property for personal use. Next, we move on to small business and self-employed retirement plans. So, the tax law provides favorable tax treatment to contributions by or for employees to qualified retirement plans. So, under the tax law, this favorable tax treatment is granted to contributions by or for employees to qualified retirement plans. So, one of the benefits is that employers, they can claim a deduction in the current year, and employees do not include employer contributions in income until the contributed amounts are being distributed. The tax on the earnings on the amounts contributed is deferred, And most retirement plans have a number of requirements in order to be classified as qualified. Most require a benefit to be extended to all employees. It can't just be a few. Most require a separate account to hold the retirement assets, whether it's a bank or a financial institution. Most penalize or prohibit early withdrawals, and some require immediate vesting of the contribution. So the contributions are immediately set aside for the employee in certain cases, right? So again, there's some requirements in order for it to be considered qualified. Over time, tax law has created various retirement plans that's aimed at small business owners and self-employed sole proprietors. So this includes payroll deduction IRAs, SEP plans, simple plans, qualified plans, including a 401k, 403b, 457c plans, and other qualified plans such as profit sharing plans, money purchase plans, and employee stock ownership plans. Each of these different types of plans involve a different plan creation, in addition to approval process and different contribution and deduction limits. So as it relates to the payroll deduction plans, this is probably the simplest way for a business to give employees a way to save for retirement. So the employer essentially sets up a payroll deduction IRA with the financial institution, and employees have the option to participate. So employees, they'll open the IRA or the Roth IRA, and from there they'll choose how much they want to deduct from their pay and contribute it to a traditional IRA or a Roth IRA, depending on what options are available to them. The employer, again, makes no contributions. Next, we have a simplified employee pension plan, SEP. With a SEP, it's an IRA-based retirement plan that's available to any employer, including self-employed individuals. So these plans, fairly simple to establish. The IRS even provides a one-page document form 5305-SEP that can be used to help set up the plan. And depending on the financial institution, they'll handle most of the paperwork. SEPs have flexible funding requirements in the event that funding the plan with consistent contributions it might be an issue, right? Because sometimes cash flow is slow in the business. So in the event, it's a bit flexible. So participants must meet requirements for the minimum age and years of service. Employees must make at least $750 in annual compensation in 2023, and the contribution amounts can change from year to year. So it doesn't have to be a set amount. Contributions and deductions are limited under different rules for employees versus self-employed business owners. Maximum contribution made for employee and related deduction, it cannot exceed the lesser of 25% of the employee's compensation, or $66,000. Maximum contribution for self-employed business owner, it's the same as for employees. However, the deduction limit considers the net self-employment income after consideration of the deduction in order to determine the contribution to the step. Next, we have what's called simple IRAs. So savings incentive match plan for employees is how we determine, that's the acronym for simple. So a simple IRA, it's available to any employer that has 100 or fewer employees, and this includes a self-employed individual. So simple IRAs, much like a SEP, it's fairly similar to establish with the IRS. There's form 5304 simple or 5305 simple. An employer that has a simple IRA, they may not offer any other retirement plan. And the simple IRA must be offered to employees with compensation of at least $5,000 in any prior 2 years, and are expected to have compensation of $5,000 in the current year. So unlike a SEP, simple IRA requires certain contributions must be made by the employer. So both employer and employee, they're eligible to contribute an annual limit of $15,500. $19,000 for taxpayers that are age 50 and older. And again, it must be offered to employees with compensation of at least $5,000 in any prior 2 years and are expected to have $5,000 earned in compensation in the current year. And the employer must match the contributing employees for the first 3% of compensation or 2% of each eligible employee's compensation up to $330,000 for any employee in 2023, regardless of that employee's contributions. So employees, they immediately vest in both the employee and employer's contributions, and the employer and employee contribution, it's excluded from gross income if within the annual limits. The employee contribution is $15,500 plus catch-ups of $3,500 if the taxpayer is age 50 or older, hence the total $19,000. Next, we have what's called qualified plans. These generally have a greater administrative burden and expense on the part of the employer. So with these qualified plans, again, it's the employer, right, that needs to determine it. So qualified plans, they're a classification of retirement plans. They offer the same benefits, but generally, again, the administrative burden is more for the employer. So most of these qualified plans require a plan document. They also have to do annual reporting of the plan assets and report it on Form 5500. And there's a special annual IRS testing that's required to ensure that the plan doesn't only favor the highly compensated employees. So as a result, generally only mid-sized and larger employers would consider operating one of these types of retirement plans. So some plans in this category includes 401k, profit sharing plans, money purchase plans, 403 plans, 457 plans, and other defined contribution and defined benefit plans. Next, we have traditional 401k plans. And these plans permit employees to either receive a direct payment, or the employee rather, to either receive a direct payment of compensation in cash, or two, defer the amount through an employer contribution made on behalf of the employee to a profit sharing or stock bonus plan. The employee may be allowed to reduce compensation or forego an increase in compensation with the amount that's contributed to a qualified retirement plan. Therefore, ultimately, they're deferring tax on the compensation. Employees choose the percentage of their pay to be withheld and contributed to the plan. And depending on the employer, some employers match the employee's contribution up to a certain percentage in order to encourage participation. So for most 401k plans, contributions are limited in two ways. The annual contribution cannot exceed $22,500, $30,000 for taxpayers that are age 50 or older. Contributions amounts are subject to limitations that's applicable to all qualified plans. 25% of compensation subjected to a limit of $66,000, plus there's some cash up contributions if over the age of 50. The employer's deduction for contributions to a traditional 401k plan, it's limited to 25% of the total compensation in comparison to all participating employees. Next, we have a simple 401k. This is available to employees with 100 or fewer employers. It's similar to a simple IRA. You must have a plan document and meet the qualification rules of a traditional 401k. And there's some other 401k plans. One of the newest types of traditional 401k plans is the automatic enrollment 401k. We have the safe harbor 401k plans. They're for small businesses with employees. They operate like other 401k plans with one exception. They require immediate vesting for employer contributions. Roth 401k plans have the same contribution limits as the traditional 401k plans, but contributions do not reduce the employee's taxable income, same as contributions to a Roth IRA. Self-employed 401k or solo 401k plans are designed for self-employed individuals that have no employees. And next, we have some other qualified plans. So we have a profit sharing plan. And this requires a plan document and annual reporting and permits a discretionary contribution for employers only. There's no employee contributions. This permits the employer to make contributions in some years and none in others. They offer flexible vesting options, but must vest at least as quickly as required under tax law. And contributions are limited to the lesser of 100% of the employee's compensation, or 66,000. There's a money purchase plan. It has similar requirements, but it requires a readily determinable employer contribution each year, typically based on a percentage of each employee's compensation. And this permits employees to make elective contributions. Next, we have a 401(b). This is a qualified plan, sometimes referred to as a tax sheltered annuity. This is offered by public schools, colleges, universities, and certain 501(c)(3) tax exempt organizations. Then we have a 457(b) plan, and it can differ depending on whether it's created for a governmental entity or for a non-governmental tax exempt entity, not necessarily one that's a 501(c)(3). And there were some big changes that took place. So in December of 2022, the Consolidated Appropriations Act 2023 was signed into law, and it included the large omnibus bill with Secured 2.0 Act 2022, often referred to as the Act. So the Act, it contained almost 100 new rules that were designed to impact savings for retirement and retirement plans. And much of the Act was directed toward changes in plan administration that was handled by plan fiduciaries, but included certain changes that are likely to affect individuals over the next few years. So some of the changes, as you can see here, the simple SEP IRAs and most qualified plans can accept Roth contributions. There was an expanded credit for plan startup costs for certain smaller eligible employees, and they also added a new credit for employer contributions made to the plan. There's a permittance of a de minimis financial benefit to encourage participation in qualified plans. They enacted additional exclusions to avoid the 10% penalty tax. The 401(k) and 403 plans, they're required to automatically enroll employees once they are eligible. Implements an inflation adjustment for the $1,000 catch-up for IRA contributions. It increases the catch-up amount for taxpayers age 60 through 63. And eligible employees' payment on higher education student loan treated as an elective deferral to qualify for a 401(k), 403(b), governmental 457(b), and simple plans. S corporations, they can sell stock to an employee stock option under certain conditions and defer the recognition of the gain on the sale. And employers will be permitted to make additional non-elective simple plan contributions of a uniform percentage up to the lesser of 10% of compensation or $5,000. And simple plans now have higher contribution limits. All right, so this brings us to our other 4 AGI deductions. We have our educator expenses. So eligible educators, they may deduct up to $300 for unreimbursed cost of classroom materials, books, computers, equipment, etc., and supplies used in the prevention of the spread of COVID-19 in order to arrive at AGI. So there are a number of other deductions for AGI available under the tax law. So because of the limited nature of these deductions, as we see here, and they're not often used, right? And sometimes people don't even know that these deductions are available. So that's why it's very pertinent that as a tax professional that you are aware of these deductions, because you don't want your clients to overpay. You don't want them to miss deductions. So an eligible educator is a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide for at least 900 hours a school year in a school that provides elementary or secondary education. If married, filing jointly, couple, or both eligible educators, there's a total deduction up to $600, but not more than $300 per spouse. Next, we have unreimbursed business expenses for performing artists. So unfortunately, because of the Tax Cuts and Jobs Act, Employees that incur business expenses are no longer allowed to deduct those costs as an itemized deduction subject to 2%. So the Tax Cuts and Jobs Act changed that. So in light of that, there's only 3 different types of taxpayers that are still eligible to claim this deduction. And the rules are different for each. So we have performing artists who worked for at least 2 employers during the year, received at least 200 each for any of these 2 employers, had business expenses of more than 10% of gross income, and had AGI of 16,000 or less after deducting those expenses. Next, we have the National Guard or Reserve members who travel more than 100 miles away from home in connection with services in the reserves. And then we have fee basis government officials. And next, we have moving expenses. So again, there was a change. In the past, tax law provided a deduction for moving expenses to help, relieve taxpayers of a portion of the financial burden of moving from one job location to another. But under the Tax Cuts and Jobs Act, the deduction for moving expenses is currently suspended for all taxpayers except for members of the armed forces of the United States on active duty whose move is pursuant to a military order, an incident to a permanent change of station. And any reimbursements to an employee from an employer for qualified moving costs, there's no longer excluded from the employee's income. So again, there's a change in the tax law as it relates to our moving expenses. Next, we move on to our medical expenses. So we transfer from our deductions for AGI to our deductions from AGI. So we start off with medical expenses. So medical expenses are the first itemized deduction listed on Schedule A. So as we know, we have the option, once we determine adjusted gross income, in order to determine our taxable income, we subtract the greater of itemized deductions or the standard deduction. So medical expenses are the first itemized deduction on Schedule A. Taxpayers are allowed a deduction for medical expenses paid for themselves, spouses, and dependents. Unreimbursed medical expenses can only be deducted to the extent that they exceed 7.5% of the taxpayer's adjusted gross income. So the formula to calculate the deduction for medical expenses is as follows. So we factor in prescription medicine, drugs, insulin, doctors, dentists, hospitals, medical insurance premiums, and any other medical and dental expenses such as lodging, transportation. There's a mileage percentage for miles driven for medical purposes, eyeglasses, contact lenses, etc. From there, in the event that the insurance makes a reimbursement to the taxpayer, that amount needs to be subtracted. That gives you the subtotal. And from there, you factor in 7.5% of the adjusted gross income, and the excess expense is what qualifies for the medical deduction. So for individuals that have a high adjusted gross income, unless they had a very large amount of medical expenses, unfortunately, they will not be able to claim the medical expenses. Next, we have what qualifies as a medical expense. So this is basically a list here. Prescriptions, we have fees for doctors and other medical professionals, hospital fees, hearing aids, medical transportation and lodging, medical aids, a prescription for birth control, acupuncture, psychiatric, insurance premiums, certain capital expenditures deemed medically necessary by a doctor, and any nursing, home care, for someone that is chronically ill. So obviously there are medical expenses that are included, and then there are medical expenses that are not. So medical expenses that are not deductible include the cost of travel for general improvement of health, the expense of a swimming pool unless the pool is designed to specifically assist with hydrotherapeutic treatment of a taxpayer's illness, the cost of weight loss programs unless it's prescribed by a doctor. Diet foods do not qualify. the cost of marriage counseling, cosmetic surgery, unless it corrects a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. And non-prescription medicines, or those purchased illegally, are not considered deductible. So we have this example here, and it asks for us to calculate the medical expense deduction. It states, during the year, Frida and Jose paid the following medical expenses: contact lenses of $120, facelift for cosmetic purposes of $2,900, doctor bills of $1,600, medical insurance premiums of $4,800. It states they also drove 260 miles to see a cardiologist in July in their personal automobile. Their insurance company reimbursed Frida and Jose $1,000 during the year for the medical expenses. If their AGI is $31,200, calculate their medical expense deduction. So we factor in the contact lenses, the doctor bills, the medical insurance, and the transportation. As we see here, transportation was calculated as follows: 260 miles multiplied by the applicable percentage of 22 cents per mile. So that gives us $57.20 rounded down to $50. From there, we subtract the insurance reimbursement. So that gives us a subtotal of $5,577. Then we need to factor in 7.5% of AGI. So the adjusted gross income was $31,200. We multiply it by 0.075, which gives us $2,340. So we factor in the difference. Again, this 7.5% of AGI represents the ceiling floor. So therefore, $5,577 was spent, and we can only claim deductions that are in excess of that ceiling floor in this case, which is $2,340. So therefore, the medical expense that is qualified and will be reported is $3,237. And generally, once you input the information into the tax software automatically does the calculation for you. But it is very important to understand it, because these are opportunities for tax planning and strategy with the client. Next, we move on to taxes. So with our taxes, taxpayers are allowed to deduct certain state, local, and foreign taxes paid during the year. And the purpose of this deduction is essentially to help to relieve the burden of multiple taxation of the same income. However, tax law does distinguish between a tax and a fee. A tax is imposed by our government to raise revenue for general public purposes, and fees are charged with direct benefits to those that are paying the fees. So here we have some examples of deductible taxes on Schedule A: state, local, and foreign income taxes, sales taxes in lieu of state and local income taxes, state, local, and foreign real personal property taxes, and real property taxes. And just keep in mind, for foreign property taxes, they're only deductible if it's incurred with carry on a business or for production of income. So for example, rental activity. So the aggregate amount of the deduction is $10,000. So with the Tax Cuts and Jobs Act, there was a very big change, right? So with this change, the maximum amount of the tax deduction is $10,000 and $5,000 if married filing separate. And it applies to all of the following: state and local real property, state and local personal property, state and local foreign income taxes, and sales taxes. And if taxes are paid or accrued in carrying on a business or for production of income, the $10,000 aggregate limitation rule does not apply to any of the following: foreign income taxes, state, local, and foreign real property taxes, and state and local personal property taxes. So some examples of non-deductible taxes includes federal income taxes, the employee portion of Social Security taxes, the estate, inheritance, and gift taxes, excise taxes, and gasoline taxes, except when it is business related, foreign income taxes if the taxpayer elects a foreign tax credit. So as it relates to income taxes and sales tax, so the taxpayer may elect to deduct either of the following as an itemized deduction. So they can choose to deduct state and local sales and use taxes, or they can choose to deduct state and local income taxes. So one of the reasons in which a taxpayer might decide that they want to deduct the state and local sales tax instead of income tax, this will primarily benefit taxpayers that live in states where there's no income tax. So Texas, Florida, right? There's no state and local income tax. So therefore, in cases like that, it benefits them more to claim the state and local sales and use taxes. So for taxpayers that deduct state and local income taxes paid during the current year, deduction amount is total amount of state and local taxes withheld from their pay plus any amounts actually paid during the year. So that could be in the form of estimated state tax, even if the payments are from a prior year. So if a taxpayer receives a refund of taxes deducted in prior year, the refund must generally be included in the gross income that the year the refund is received. Any taxes that do not provide a tax benefit in the year paid, they're not required to be included in income in year received as a refund. So in order to calculate the deduction for sales tax, taxpayers, again, they'll use either the following: actual sales tax paid or the estimated sales tax from the IRS table. So here we have this example. It asks, how much can Cadence take for taxes as an itemized deduction? So Cadence amends her 2019 state income tax return and must pay an additional $843 in state income tax in 2023. Of the $843 she owes, $93 is for penalties and interest. Cadence has $660 of state income taxes withheld from her wages during 2023. During the year, she also paid quarterly estimated state income tax as follows: $200 each on April 15th, June 15th, August 15th of the current year, and January 15th of the next year. There's a $155 fourth quarter estimate from the prior year on January 15th of the current year. So based on this information, Candace is allowed to deduct the actual amounts that were paid in 2023, limited to $10,000 on her Schedule A. So here we factor in all of this information, and we see that we start off with $750 plus the $660 plus 200 plus 200 plus 200, because again, here we see with the $200, and well, let's make sure. How do we calculate 750? It's the 843 minus the 93 for interest and penalties. That gives us 750 plus the 660 of state income taxes. And then she made the following payments: April 15th, June 15th, and August 15th within the current year. So we add the $200 3 times, and then we factor in the $155 fourth quarter estimate from the prior year on January 15th of the current year. So we add all of these up, and that gives us $2,165. Next, we look into property taxes. So with our property taxes, these are essentially taxes that are levied on state and local real property for general public welfare. These are considered deductible. Keep in mind, if there's special assessments that are charged to provide a local benefit to property owners, these are not considered deductible. So these amounts, they increase the basis of the taxpayer's property. In addition, service fees such as garbage fees, homeowners association fees, these are not deductible as property taxes. And in the event that real estate is sold during the year, the taxpayer has to allocate between the buyer and the seller, and the division must be made according to the number of days in the year that each taxpayer held the property. An allocation is generally made by the escrow company or the closing agent, and allocation amounts are itemized on closing settlements for the sale. Next, we have personal property taxes, and in order for personal property taxes to be deductible as an itemized deduction, the personal property taxes must be levied based on the value of the property. So taxes of a fixed amount or those that are calculated on a basis other than the value, those are not considered deductible. So, for example, automobile fees that are calculated on the basis of the weight of the car, those are not considered deductible. Next, we have this pass-through entity tax. So, with this $10,000 aggregate limit on itemized deductions for state and local taxes, SALT, the abbreviation, it limits the deduction for many taxpayers in high tax states such as California, New York, New Jersey. And it also limits the deduction for many high income earners, regardless of their state of residence. So, in order to provide a workaround for the state and local tax cap, several states they've enacted a pass-through entity, a PTE tax, and that permits or requires taxpayers to remit an income tax at the entity level, and then the taxpayer reflects an income tax credit on their individual state income tax return. So essentially, by shifting the tax off of the individual taxpayer and onto the pass-through entity, the tax is an ordinary and necessary business expense of the entity for federal tax purposes. Therefore, it's no longer limited by SALT. And obviously, the equal and the offsetting credit for the individual state income tax, it mitigates double taxation at the state level. So as of June 2023, 35 states, over 35 states, they've enacted some form of this pass-through entity tax with a related credit. So, although it's similar, each state has a slightly different version. And so, if someone is, working on this for a state, got to make sure you understand it correctly. So here we have an example. How much may Selma show as an itemized deduction for taxes in 2023? Selma has an AGI of 31,300 for 2023. She itemizes her deductions and therefore deducts the allowable amount of tax. Federal income taxes are withheld for the year are 2,150. State income taxes withheld are 1,500, and Social Security taxes are $1,768. Selma paid property taxes on her house of $3,300 for the year and paid garbage fees of $867. She paid an automobile registration fee of $210, of which $30 is based on the weight of the automobile and the balance on the value. How much should she show is an itemized deduction? So in such case, we factor in the $1,500 for state income taxes. Federal income taxes are not deductible. Social Security taxes are not deductible. So we account for the $1,500 of state income taxes, the property taxes on the home of $3,300. Garbage fees are not considered deductible. And for the automobile, keep in mind, for these personal property taxes, it must be levied based on the value of the property. Automobile fees that are calculated based on the automobile's weight are not considered deductible. So 210 minus the 30 gives us 180. So we add the 1,500 for state income taxes plus the 3,300 for property taxes plus the difference between the automobile registration minus the $30 that was based on the weight of the automobile. And the total itemized deduction for taxes is $4,980. Next, we move on to interest. And interest is an amount paid for the use of borrowed funds. So taxpayers are allowed a deduction for certain interest paid or accrued during the tax year. So the type and the amount of the deduction, it depends on the purpose for which the money was borrowed. So interest on loans for business, rent, royalty activities, these are deducted for adjusted gross income, but there's certain interest on personal loans that are considered deductible as an itemized deduction. So the following types of personal interests are deductible. This includes qualified residence interest, mortgage interest prepayment penalties, investment interest, and certain interests associated with passive activities. So consumer interest, unfortunately, is not considered deductible. So this includes credit card interest, interest on a car. Those are not considered deductible. And the deduction for a private mortgage interest expired at the end of 2021. So one of the key things is that in order to deduct interest on a debt, the taxpayer must be legally liable for the debt. So no deduction is allowed for payments made for another's obligation where the taxpayer is not liable for payment. Also, both the lender and the borrower, they must intend for the loan to be repaid. As it relates to prepaid interest, so cash basis taxpayers, they're required to use the accrual basis for deducting prepaid interest. So therefore, prepaid interest must be capitalized and the deduction is going to be spread over the life of the loan. So there's one exception: points on a mortgage loan for purchasing or improving the taxpayer's principal residence may be deducted in the year they are paid. So again, no deduction is available for consumer personal interest on credit cards, loans for personal automobiles, etc. However, qualified residence interest is a type of personal interest that's specifically allowed by the Internal Revenue Code. So the term qualified residence is the interest paid qualified residence interest rather is the interest paid on qualified residence acquisition debt, and the term qualified residence acquisition debt is defined as debt secured by the taxpayer's principal or second residence in acquiring, constructing, or substantially improving the residence. Interest deduction for qualified mortgage debt, it's been lowered from $1 million to $750,000 through 2025. For qualified mortgage debt incurred on or before the Tax Cuts and Jobs Act, the prior year rules still apply. So that's considered grandfather debt. An interest deduction of up to $100,000 of home equity debt has been suspended through 2025, again, in light of the Tax Cuts and Jobs Act. So next we have education loan interest. Taxpayers are allowed a deduction for adjusted gross income and above the line deduction for certain interest paid on qualified educational loans. So the deduction limit is $2,500. It does phase out if it is a single taxpayer with AGI of 75,000 to 90. And married taxpayers with modified adjusted gross income of 155,000 to 185,000. Next, we have investment interest. So to prevent the abuse by taxpayers, the Internal Revenue Code includes a provision that limits the deduction of investment interest expense. So this provision ultimately, it limits the amount of deductible interest on loans to finance investments. So the investment interest deduction is limited to the taxpayer's net investment income. So net investment income, and we see here that includes dividends, that includes interest. Dividends and capital gains may only be included as investment income if the taxpayer calculates tax on them at ordinary income tax rates, because as we know, dividends and capital gains are taxed at a preferential tax rate. Any unused investment interest expense can be carried forward and deducted in future years, but only to the extent that the taxpayer's net investment income exceeds the investment interest expense for that year. And the investment income deduction is reported on Form 4952. Next, we move on to our charitable contributions. So in order to encourage individuals to be socially responsible, the Internal Revenue Code allows a deduction for charitable contributions. So in order to be deductible, the donation must be made in cash or property, and the value of free use of a taxpayer's property by the charitable organization does not qualify. Any out-of-pocket expenses related to qualified charitable activities, they are considered deductible. There's a mileage deduction of 14 cents per mile. And in order to be deductible, there's a very strict list of what qualifies and what does not. So in the event that, let's say, a taxpayer has doubt as to the deductibility of a payment to a specific organization, they can review the IRS's online search tool called the Tax Exempt Organization Search. So that way they can confirm whether or not the amount can be deducted. So the following gifts are not considered deductible: Any gifts to non-qualified recipients. So for example, if you give money to someone that's homeless, a labor union, political parties, contributions of time, service, the use of property or blood is not considered deductible. Contributions where benefit is received from the contribution, and wagering losses if there's a church bingo or raffle tickets. If a taxpayer donates cash, the deduction is fairly simple. It's equal to the cash amount. If the taxpayer donates property, however, the deduction is equal to the fair market value of the property at the time of the donation. There is an exception. If the donated property would have resulted in ordinary income or short-term capital gain, the deduction is equal to the property's fair market value less the amount of ordinary income or short-term capital gain that would have resulted if the property had been sold. And if the property would have produced the long-term capital gain, the deduction is generally equal to the fair market value of the property at the time of the donation. So there's an exception if the donation is tangible personal property made to an organization that uses the property for a purpose that's unrelated to the organization's primary purpose, then in such case, the deduction is equal to the property fair market value. So here we see in this example, would Bonnie's deduction change if she had donated the couch to an environmental organization? How much may Bonnie deduct for contributions? States Bonnie donates an antique couch to a nonprofit that provides housing items to victims of domestic violence. So as we see here, she's donating the antique couch and the organization is using the couch to further its mission. The couch cost $2,500 and is now worth $4,000. How much can Bonnie deduct? And what would be the deduction if she donated the couch to an environmental organization? So our solution is as follows. Since the couch is being put to use related to the organization's primary purpose, the deduction is equal to the fair market value of the couch. But in the event that Bonnie donated the couch to an environment organization, the purpose is unrelated. So therefore, she has to reduce her deduction by the amount of the long-term capital gain that would have resulted if the item were sold. So it'll be 4,000 minus the difference between the gain. She purchased the couch for 2,500. Now it's worth 4,000. So she would have recognized a gain of 1,500. So the fair market value minus the long-term capital gain, Bonnie would be eligible for a $2,500 deduction. So as it relates to charitable contributions, there are some percentage limitations. So there's different limits that apply to different types of charitable contributions, and it depends to whom the contribution is made. So the rules for charitable contributions classify organizations as either 1, a 50% organization, or 2, any other charitable organization, a non-50% organization. So public charities, churches, most educational institutions, hospitals, the U.S. or any state or local government, all private operating foundations, private non-operating foundations, if they distribute the contributions to public charities within a specific period of time. And any other qualified organization is a non-50% organization. All right, so there's currently 4 different limitations, all of which represent a percentage of the taxpayer's AGI. There's a 60% limitation, a 50% limitation, a 30% limitation, and a 20% limitation. So obviously, this area of tax law can become very complex. So the IRS provides a worksheet in publication 526. So gifts to non-50% charitable organizations are limited to 30% of AGI. For contributions of long-term capital gain property, the contribution limit is 30% if the full fair market value of the property is deducted and contribution is to a 50% organization. Long-term capital gain property donated to other than a 50% organization is subject to 20% AGI limitation, and there's no charitable contribution deduction allowed for payment to a college or university in exchange for the right to purchase tickets or seating at an athletic event. And there are some substantiation rules. Again, you want to make sure, because some people, they would just, write things off that they didn't actually do. So taxpayers, they must keep records, receipts, canceled checks, and other proof of charitable contributions. So for gifts of property such as clothes or household goods given to the Salvation Army, for example, if they total over 500, the taxpayer has to attach what's called Form 8283 to their return, given the name and address of the donee, the date of the contribution, a description of the property, the approximate date of acquisition of the property, and certain other required information. For larger gifts of property that's worth $5,000 or more, in such case, the donor also needs to obtain an appraisal. There's no charitable deduction allowed for contributions of $250 or more unless the taxpayer can substantiate that contribution with written acknowledgement from the charitable organization. In the event that a charity knowingly provides false written acknowledgement, they're subject to penalty, generally $1,000. And again, the key thing is you want to make sure that there is substantiation, there is proof. Gifts of clothing and household items, they must be in good condition or better to qualify for a deduction. Deduction for a donated vehicle, boat, plane is limited to the amount for which the charity sells the property. The charity is required to provide the resale information on Form 1098C and send it to the taxpayers, who need to attach the 1098C to their tax returns for deduction substantiation. And a taxpayer, they may claim the estimated value if the charity uses the donated property or gives it to a needy individual rather than selling it. So for quid pro contributions, these are donations involving receipt of goods or services by the donee of more than 75. Charities must provide donors with written disclosures, and these disclosures must provide donors with good faith estimates of the value of the goods and services, must inform donors that only contribution amounts in excess of the value of the goods and services are deductible. And there's a penalty of $10 per contribution per event, capped at $5,000, that may be imposed on charities that fail to make these disclosures. So here we have an example. It states, what is Clem's charitable contribution deduction if his AGI is $33,200? During the current year, Clem donates $1,260 to a synagogue's youth group, allows the youth group to use his lake cabin valued at $500, drives 1,000 miles on behalf of the YWCA, and donates a vehicle valued at $950 to the Women in Need shelter. The shelter sells the automobile for $750 and issues a Form 1098C to Clem. So in such case, we account for the 1,260 that was paid in cash. It lets us know that there were 1,000 miles driven, so 1,000 miles multiplied by 14% plus the $750. The total deduction is $2,150. So the free use of the lake cabin is not considered deductible. So next we move on to some other itemized deductions. So the final portion of this chapter discusses casualty and theft losses, other miscellaneous deductions, and the phase out of itemized deductions for high income taxpayers. So taxpayers are allowed deductions for certain casualty and theft losses. The deductions may be itemized deductions, or in the event that, let's say, it's related to a business, it will be considered a deduction for adjusted gross income. So a casualty is a complete or partial destruction of property resulting from an identifiable event of sudden, unexpected, or unusual nature. So for example, property damage from storms, hurricane, flood, fires, vandalism. Theft losses are deductible if the taxpayer can prove theft occurred. Casualty losses are deductible in the year of occurrence, except for federally declared disaster area losses. Theft losses are deductible in the year that the theft is discovered. So in order to measure the loss, the amount of the casualty or theft loss is measured by one of the following two rules. Rule A, the deduction is based on the decrease in the fair market value of the property, not to exceed the adjusted basis of the property. And this applies to partial destruction of business or investment property, partial or complete destruction of personal property. And then there's rule B. The deduction is based on the adjusted basis of the property. And this applies to the complete destruction of business and investment property. And as it relates to the deduction limits, personal casualty losses are deductible only if attributable to a federally declared disaster. And such losses are subject to a $100 for per casualty and must exceed 10% of AGI to be deducted. Next, we just have some other expenses. So miscellaneous itemized deductions are categorized into two types: those subject to the 2% AGI floor and those not subject to the 2% AGI floor. So the most common deductions subjected to the 2% AGI rule are unreimbursed employee business expenses and employee expenses reimbursed under a non-accountable plan, investment expenses, and other miscellaneous expenses, including all important tax preparation fees. The Tax Cuts and Jobs Act suspended the deduction of all miscellaneous itemized deductions subjected to this 2% rule, and miscellaneous itemized deductions that are not subjected to the 2% floor, those were not affected. So as it relates to the phase out of itemized deductions, prior to 2018, certain high income taxpayers, they were subjected to limits on the amount of itemized deductions. So certain AGI limits for different filing statuses, it triggered a reduction in itemized deductions by the lesser of either 3% of the excess of the taxpayer's AGI over the threshold amount, or 80% of itemized deductions, excluding deductions for medical expenses, investment interest expense, casualty and theft losses, and gambling losses to the extent of the gambling income. So the Tax Cuts and Jobs Act, again, it suspended the phase out through 2025. So this brings us to the end of chapter 5, deductions for and from AGI. So now that the lesson has ended, you should have learned how to explain how health savings accounts, HSAs, can be used for tax-advantaged medical care, describe the self-employed health insurance deduction, explain the treatment of individual retirement accounts, IRAs, including Roth IRAs, explain the general contribution rules for small business and self-employed retirement plans, describe other adjustments for adjusted gross income, calculate the itemized deduction for medical expenses, calculate the itemized deduction for taxes, apply the rules for an individual taxpayer's interest deduction, describe the charitable contribution deductions, and describe other itemized deductions.